What you're looking at on the screen right now is a comparison of all of the major currencies that we talk so much about this on this YouTube channel in the last few years, going back from basically the beginning of 2022. And what we can see here is that the color white, the line chart here, represents the US dollar. And everything else is all these other colors, right? You have the Japanese yen, and you have the Australian dollar, and you have, of course, the euro and the British pound. And the point I'm trying to make here is that during the last few years, the dollar has been the king. In fact, you might have even heard this expression of king dollar. It's like the US dollar is wearing a crown or something. But the question is, as we go into 2024, is the dollar about to get dethroned? And I want to talk a little bit about why that might be the case and illustrate my outlook for the US dollar as we turn the year into 2024 here. So first of all, I want to talk about something that was going on over here. During this period of time, we saw elevated levels of inflation, and the Federal Reserve was all over the place with their rate hike expectations, just saying that inflation was a stubborn issue and that we do not see, the need to stop rate hiking until this problem goes away. We're willing to let the economy hurt a little bit if it needs to. Pretty much what we kept hearing over and over. And during that time, we saw the other major central banks not quite able to keep up with all of that rate hike talks. Of course, during this time, the US economy was comparatively the strongest, and arguably is still one of the strongest of the major economies. However, what we saw in the following months as this rate hike cycle began is that many other central banks were not able to keep up with those massive and rapid rate hikes that we saw in the US, despite these other places also experiencing high levels of inflation. So we saw a lot of rate hikes because, again, the Fed was worried about inflation, but other economies and other central banks, more specifically, were not able to keep up with the hikes. Well, now we see something totally different. Now inflation has come down meaningfully, and in fact, I have some data to show that to you right now. So check this chart out. This is an inflation study on the Edge Finder that I just pulled up, and I tagged the US dollar, the Japanese yen, the pound, and the euro. And all of these things are showing a nice moderation in inflation across the board. Noticeably, the US dollar is in the blue here. And what we can see is that inflation is coming down. And that is why the Fed is not so worried about hiking rates. And now as we turn the corner, we're now talking about rate cuts in 2024. The Fed has openly stated at the time of recording this video that they expect about 3 rate cuts in this year. And when you take a look at that and you say, well, if rate hikes were what caused a massive run up in the dollar, could it be rate cuts that causes a large drop in the US dollar? Definitely something to consider as we take a look at the price action chart now. So we're taking a look at the US dollar on a weekly chart right here. And what you'll notice is that we are definitely seeing a meaningful drop or change in pace from those crazy days during 2022. By the way, we'll pop up some of the thumbnails that I was making during 2022. It was a crazy time in content land for us because it seemed like every week there was something to report on the US dollar just going higher and higher and higher. This was a crazy period in markets, and if you traded during that time, then you probably remember it was a pretty scary time in markets. Everything except the dollar was pretty much dropping. Anyways, in 2023, we saw that behavior really change. The dollar index came down meaningfully and then spiked mid-year in the summer months as we saw an uptick again in inflation. People were concerned about that, but now it seems like we really do have inflation on the ropes. But the question now becomes, is this going to meaningfully turn into a dollar drop from here? And I think that the answer is, if you're taking a look at a weekly chart, again, inflation concerns really subsided and then they ramped back up. Well, they're subsiding again. So from a purely simplistic standpoint, it makes a lot of sense to me that we would see a retest on the dollar index back down to these levels here that we saw previously, about a 100 mark. And I've talked about this level for some time on the weekly chart for the dollar index. We're seeing a series of lower lows and lower highs on the dollar index. And I think it's probably fair to assume that we could see a drop in the dollar index down to 100 during the course of 2024, if not sooner than that. It could be in the first half of 2024. It just very much depends on what the Fed has to say about rate cuts specifically. I think that's what's really going to move the needle here for us dollar bears as we turn the new year. Here's a look at the daily chart, and what you can see is we can mark up this chart pretty quick, and we'll do some editing magic really quick, and we'll fast forward as I draw in my zones here. Okay, so I've drawn in a couple zones here on the daily chart, and what you'll notice is that we've got some pretty key market structure here that is still trending overall to the downside. Now, in the most recent of times, as we record this video, we've seen a little bit of an uptick in the dollar index. And I think that this could just be simply a bit of a bear market rally. We're seeing a nice, solid move lower and now seeing the pullback. I think this is healthy even for dollar bears to admit that this is probably just fine. Nothing is substantially broken. And even if we do start to trade above this level, meaning we trade, perhaps into this next area, it has been quite extended to the downside for a little bit. So I think a lot of the excitement around rate cuts has already really been pushed into this market. We've seen the dollar index sell off substantially from that. I actually think that a push up in the dollar is healthy for a possible, longer term selling position. So I'll be watching this close. And even if this trend line breaks, this is why personally I'm more fixated on horizontal key levels rather than trend line levels. Trend lines can be drawn in different ways, and I find them to be a little bit harder to, gauge compared to strictly looking at horizontal key structural levels. But again, there's that longer term weekly chart level that we discussed. And I still think that price is due to try and come back to test this at some point here in 2024. We'll mark that as our demand zone. And I think the idea here is that we've seen a consistent pattern. Each time this market finds a key level, it does reject it. When it retests underneath, it falls. So we'll see if that does play out and if we could get a sooner than expected push down to that 100 level. But for me, like I said, I am overall price action wise bearish on the daily chart. However, that being said, if we take a look at the 4-hour chart, we have seen an impressive kind of break of the downward trend that we've seen recently. But again, like I said, I think this is a short-term move that sellers could find their way into as we progress in 2024. And just a little heads up, if you stick around till later in this video, we'll be taking a look at some other currency pairs specifically against the dollar. I'd like to look at things like euro, pound, dollar yen, Aussie dollar, and USD CAD. If you stick around later into this video, then I'll definitely go through those with you. I do also want to get some other data here before we jump over to those specific charts. Also, by the way, I just want to call your attention to the broker links down below in the description. If you're looking to trade specific currency pairs and you don't already have a currency broker, there's a few links there for recommended brokers, whether you're inside of the US or outside of the US. A couple recommended brokers are down there. You don't have to use those links, of course. If you're just looking for a broker, you don't have to use them. But if you do choose to use those links, you'll be supporting my YouTube channel, and I very much appreciate that. Next up, before we get into more market data, I want to talk about yields. 2-year yield and the 10-year yield are both trading much lower than they were just a few weeks ago. We've seen the 2-year government bond yield come down from what was near a 5.3% almost level all the way down to where we trade today, 4.32%. Now, what does this have to do if you're a currency trader, commodity trader, or you just are focused on the dollar? Well, actually a lot. Yields tell you pretty much what the bond market thinks about what the Federal Reserve is going to do next. So what we're seeing here is that yields are dropping because they expect federal funds rate to drop. And because the 2-year very closely reflects what the Fed is kind of looking to do, or Fed monetary policy outlook is looking to do, this one can be a really key indicator in what the dollar might do next, right? So we're seeing a big drop in yields, and that's tugging the dollar down for sure, I think, and one of the larger contributors to the bearishness that we've seen. Same thing with the 10-year, which is a longer duration bond. We're seeing a big drop off all the way from 5% down to 3.92%. And one thing I think that's really important to look at is the yield curve. I'm going to show you that data now. So we're having a look at the A1 Edge Finder's new US Treasury yield curve chart, and ignore the little text down here. We're still kind of under construction with this new chart, but it is in the Edge Finder, by the way. If you're an Edge Finder user, just head over to our new tab, US Treasury Yield Curve. By the way, this should be a good opportunity to let you know about our company behind the scenes. If you go to a1trading.com, we build software tools for traders. That is how we, of course, support the work on this channel as well as our business as a whole. We're a software company that builds specially made tools for FX, commodities, and indices traders. So head over to a1trading.com if you haven't already. We're taking a look here at the US Treasury yield chart. And what this is doing is it's actually comparing the 3-month chart relative to the 10-year yield. Now, what the heck does all that mean, Nick? Well, what it tells you is that when this thing is trading above or it becomes negative, we call that an inverted yield curve. And the idea there is basically that short-term government bonds are yielding higher amounts in percentage form per year than long-duration bonds. And that is something that can actually signal potential early warnings of recession. In fact, in many historical instances, that has actually prefaced big recessionary periods in the United States. Actually, I think it has a 100% hit rate. It happened in 2020. It happened in 2007. It happened in 2001. And all three of those indicated recessionary periods that followed. So with this major jump in the inversion right now, what the heck do we do with that? Well, I think it's worth mentioning that the bond market sell-off that's happened this past few years is the worst in US history. And we're seeing a massive inversion in the yield curve. But I want to say something. This can actually remain inverted for some period of time before it actually does kind of boil over. In fact, in 2007, you can actually see, or 2006, the market traded higher for another almost 2 years before it became uninverted, and that actually signaled the recessionary start period to follow in 2008. So just a heads up, it actually could remain inverted for much longer than we expect. So I'm not necessarily saying that this is a crashing signal or anything like that, but if you do start to see this thing drop substantially, watch out, because what's likely to happen is the US dollar could become a little bit of a scary place to be, as the money printers would come on and fear would spike suddenly, and perhaps faith in the dollar would be coming into question as bond yields plummeted and bond prices jumped tremendously. Next up on our data to go through today is the COT's Net Positioning section, where we're going to talk a little bit about the US dollar in particular. In fact, we'll isolate the dollar here now. Okay, so we're taking a look at the US dollar, and what you'll see is that on the non-commercial net positioning factor, we see about a 55 to 45%, give or take, long to short ratio. That doesn't tell us too much, but what does tell us something is that this has dramatically come down from recent months. Let me show you that data next. So what you can see here, we're now taking a look at the smart money indicator page, is that we're crossing the euro against the US dollar, and you can actually see that the net COT long percentage has dropped suddenly in recent months, and the short percentage has actually jumped up pretty substantially as well when isolating the US dollar. But when we look at something like the euro crossed against the dollar, which is perhaps the easiest one to compare the US dollar to. Remember, with currencies, you're constantly doing a comparison. When you have to take one currency, you pretty much quote currencies relative to other currencies. And when we take a look at the euro, check this out. For quite some time, we saw institutional money very bearish when it came to the currency pair cross, meaning they were more positioned short the euro, long the dollar. That has since flipped, and we can actually see the price here, the white line of the euro dollar, has been meaningfully trading higher, and COT positioning, the blue line, has also been moving higher. Meanwhile, noticeably, net retail position has become pretty bearish overall, with a recent spike up in bullishness, but overall still in the negative camp for sure. I find this to be very interesting when we take a look at what smart money is doing relative to retail money, and this indicator, like I said, is available with the Edge Finder. If you would like a copy of the Edge Finder, by the way, you can message us on our website. We have a support line available anytime that you'd like to message in and ask about current discounts or questions about the software that we're using to do these analysis videos. If that would be helpful to you, if you would like a copy, send us a direct message on that first link down below in the description. When you do that, you'll get an extra discount if you mention that you're a YouTube subscriber and that you're watching the video as you send the message. Make sure to do that. Again, it's a nice little extra perk for viewers on my channel. I very much appreciate your viewership and hope that you'll watch more videos in the future. Next up is a crowd favorite. This is the US debt clock, and it is a interesting site to keep up with, although it's a little bit scary if I'm saying honestly how I feel about it. It constantly ticks higher. We see the US national debt going up and up and up. And people sometimes wonder, is that ever going to come down? And the answer is probably not, unless there is a massive, will the national debt come down? Possibly, arguably in the future, but currently as it stands, as a country, we spend way more than we earn. And, that's a little bit concerning, of course. But what we see here is that we're currently sitting at $34 trillion. With a capital T. It's just hitting new highs constantly, all-time highs, that is. And I think it's worth mentioning that the national debt being called into question, if we do start to get concerns. Last year, Moody's actually took the U.S. Treasury's ability to pay back its debt. It took it from a AAA rating down to, I believe it was an A++ or something like that. It was a lower tier, not by much, but meaningfully enough to mention. And if that does actually serve as a bigger problem, if U.S. national debt concerns continue to spike, that actually could be a serious downside move for the US dollar index. In fact, that's perhaps one of the biggest tail risks of them all, is if, bonds and could not sell and the trust in the dollar went out the window for a variety of different reasons, perhaps the BRICS nation stuff, or perhaps people just start to really wonder if the US is able to even pay back the debt, as we're printing so much money and taking on so much debt. It just seems to keep getting bigger and bigger. It's a little bit concerning, to say the very least. Okay, so I promised I would take a look at some currency pairs here if you stuck around. So let's take a look now at some of those that I mentioned. The euro dollar here is trading what seems to be in a nice new upward trend. And I'll do a quick markup on this. We'll speed up and come back. Okay, and with the power of editing magic, we're back in real time here. I'm taking a look at this, and basically what I see is that the overall change in the trend that we saw, looking left, longer term downward trend on the daily chart, totally flipped here. Second half of 2023, we really started to see that dollar become weak, and that's given us a nice upward trend here overall on the euro. We found support around 1.075. Recently, we've come into a little bit of resistance here at the 1.11 mark. I do think that we could come back to retest that area, and if that level breaks, that could be the start of another wave higher for the euro dollar. But if we do retest levels like 1.075, I think I'm still a bull, generally speaking, and think that we could find support from there. But again, overall, longer term picture here for me on the euro this year is, for now, slightly more bullish than bearish. I wouldn't say I'm a super big bull when it comes to the euro dollar, as the euro has its own list of problems that we could get into in another video. By the way, if you are enjoying this video and you'd like to see more like it in the future, do two things for me. Number one, hit that thumbs up button on the video down below. And number two, subscribe for more content with the notification bell on so that you can get notified when new videos drop. Next up, we'll take a look at the pound dollar. And again, we'll go into super speed here as I mark up the chart. Okay, so pretty much same concept as the euro. We saw a big flip in the trend on the daily chart, and now seemingly have found some nice levels of support that we continue to bounce off of. I think this overall bullish story stays intact, especially if you get a breakout that actually could be a nice continuation pattern. And I really think the only thing that would price action wise change substantially my view on the pound going into this year would be, if we started to see breaks of these key levels that I just marked up on my chart. Another noticeable thing is that we talked about this at the beginning of the video. We talked about how the dollar kind of led the charge in interest rate hikes. It seems like specifically the Bank of England right now, at the time of recording this, is lagging behind in the rate cut story. That has me generally more bullish on the pound than on the dollar. And you might ask why. Well, remember, rate hikes or higher interest rates generally make the currency more attractive, as it restricts the money supply, the balance sheet, etc., tightening monetary policy. Think about it. If there's more dollars in the world, that's going to make the dollar less valuable. And if there's less dollars in the world, if the balance sheet is being reduced, aka that can actually be very bullish for the dollar, or in this case, what I'm saying about the pound, for the pound. So I think that is also worth mentioning. Next up is dollar yen. Okay, so we're looking at UJ, and I marked up a couple key levels here. Overall, I think the trend here is very much the downside, especially when we talk about the Bank of Japan, which has flirted with the idea of actually getting their interest rate more into the positive territory. And if that happens, meanwhile, the US is talking about rate cuts, I think the story tells itself on why the dollar yen has been so bearish and why I think it actually could continue to be bearish. Now, again, from a price action standpoint, rallies into these areas are generally, in my view, are going to be more bearish. But the question will be, as you get into those levels, watching for the signals on the lower time frames to actually look for trades. Now, of course, if I take any trades, I just want to clarify, we do also offer a signal service where you can get notified with full breakdowns and explanations why I take each trade, when I take each trade, my entries, my exits, my stop loss, all that sort of good stuff. If you would like to get notified of that, again, first link down below in the description, shoot us a message letting us know that you'd like to join the team, and we will get you hooked up with a membership for a nice subscriber discount. Like I said, just let them know that you're watching the video. They'll get you a nice subscriber discount. Next up, the Australian dollar is moving higher overall. And I would say, the idea here behind the Australian dollar is very similar to, a risk on general, asset. We do see, like, for example, the stock market is trading higher off the idea that rates are coming down. Well, similar concept for the Australian dollar, especially where the RBA, the Royal Bank of Australia, is not particularly dovish when compared to the US dollar or the Federal Reserve at the time of recording this. Either ways, let's mark up the chart really quick. Okay, and again, very simple technical analysis. We don't get too far into the technical stuff. I know a lot of traders love to deep dive and make things complicated, but I draw my zones very, very simple, and I look to trade them mostly based on fundamentals. Like I said, just another plug for the Discord. If you do want to join that, we combine technicals and fundamentals in that. And if you're looking to do the same and looking to learn what I think is, what institutional traders really do, they don't just look at pure technical charts. They look at fundamentals. Now, of course, some do, but the vast majority of institutional traders that I've had the pleasure of interviewing on this channel, they are fundamental. So again, make sure to join if you're not already. Looking at the Australian dollar, this level here is the closest one at the time of recording this. We've had a nice pullback. I think the Australian dollar looks attractive at these levels, and similar to euro and pound, if we can get breakouts above, that actually could be very interesting to watch going forward. Dollar CAD is an interesting one. It has the side caveat of potentially being tied to oil in some ways. If oil prices get very strong, it could strengthen the Canadian dollar specifically and actually act to strengthen the dollar downside here, or the dollar CAD downside, right? Because if the Canadian dollar goes up due to strengthening oil, we would expect that, again, it has a huge pull on the Canadian economy. So anyways, overall, I think, downward trend here, similar to the other ones, pretty straightforward. We'll just mark up the chart. And there you go. You overall just have a very simple layout here. We've had a big slide to the downside, probably due for a little bit more squeeze up. Like I said, dollar index has been on a bit of a tear here recently in the lower time frames, but as you start to reach these levels, I would generally be more of a bear than a bull. But I think that's definitely an interesting currency pair to also watch among the list. And like I said earlier, if you're looking for a broker to trade FX, or you're looking to join a group to learn more about the ways that we trade in these videos, then all of that can be found below in the description. I hope this video was helpful to you. I put in a good bit of work here, as well as my team. We try and make these videos as helpful as we possibly can for you as a viewer. And if you appreciate that effort on our part, make sure to drop a like on the video before you head out. And I hope you have a great rest of your day. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.